afternoon. Good afternoon, everyone. It is Thursday, September 2nd. I'm your girl, Shirley Nichols with Mortgage Money with Shirley. I know it's a little late in the afternoon. I was supposed to be here 10 minutes ago with you all live on this podcast, but nevertheless, I am here. I am here right now in the studio, Morris Media Studios right here in Los Angeles. If you have any questions, comments, or concerns with today's show, then please feel free. You can call us right here in the studio today if you like. You can call right now at area code 323-815-4204. That's 323-815-4024. Or you can leave your comments on this Facebook page, my personal Facebook page, Shirley Nichols, or my business page, Clear Sky Mortgage and Realty, all on the Facebook. You can leave your comments down below. Or if you don't want to leave them down below, then just DM me. I believe they say just instant message or inbox me. You can do that, and I will return your calls or your answers to the questions you may have. And if I don't know your answers, I will get them. Okay. But today is Thursday. I just wanted to come and reach you all today with some information about mortgage lending, about the mortgage business. So again, I'm your girl, Shirley Nichols, and I am streaming live right now. My YouTube channel is open and up, so you can watch the replay on Mortgage Money with Shirley on the YouTube station. Okay. Or again, like I said, we're streaming right now live in the studios at Morris Media Studios here in Los Angeles. So what today's episode 11, what we're going to talk about, and it's going to be a brief session today because like I said, I was supposed to be here 10 minutes ago in the studios, but we were running late because life gets, wrapped up. So we're here right now, but today's topic for episode 11 is down payment and closing costs. So we're going to talk briefly about some of the ins and outs about down payments and closing costs and all that kind of good stuff. I'm not going to go into specifics about down payment programs. I do not do a lot of down payment program options at all because down payment programs are a little bit I've said this in previous podcasts. They get a little bit involved and detailed. And sometimes those programs that are allowing for down payment, sometimes they do run out of funding. Yes, they run out of funding. Sometimes it's just gone, and then you end up having to wait and purchase your house later. So down payment, we're talking more so for purchases, but with refinances, of course, we're not talking down payment, but purchases we are. And I kind of want to touch briefly on a couple of things about down payment and closing costs when you're buying a property, when you're purchasing a home and you call a lender, when you call your loan officer, when you call your broker, and you talk about purchasing a property. Okay. Down payment, closing cost, two entirely separate things. Down payment, closing cost, two entirely separate things. What did you say, Shirley? Yes, down payment and closing costs, two separate things. You're going to need them both when you're purchasing a property. Unless you're doing a VA loan, where the VA loan, you may have a seller who says, I'll cover all those costs. And with VA lending, it's a 100% financing. So you may not really need the closing costs with VA lending. You might just end up with something handed to you. That's a whole separate program. Again, VA lending is 100% financing from the lender. There are closing costs still, but you may have a seller who's gracious enough to pay those closing costs. Who knows? But let's talk about the other loan options where you're doing conventional, conforming, you're doing FHA, okay? Let's talk about those options for down payment and closing costs. What'd you say, Shirley? Down payment and closing costs, two entirely separate things. So let's make sure you're clear on that when you get your real estate agent to take you looking around for a property because you've been pre-approved. Yay, fantastic. You've been pre-approved. And when you get in your real estate agent's car or you ask them to meet you at 123 Main Street so you can put an offer in on this house, make sure you're clear and understanding you need a down payment and a closing cost. So let's talk about that. Down payment, FHA, here we go. It's 3.5% down payment of the sales price, okay? That final sales price that you and the seller agree on because you put in an offer, the seller may have countered that offer and said, no, I need a little bit more money. It's the final sales price, that dollar amount, that sales price amount. If it's $500,000, you're going to need 3.5. If the seller said, yeah, my house was on the market for 450, but I'm going to counter you for that and I want 500,000. If you sign that purchase contract, if you execute a purchase contract at 500,000, you're going to need 3.5% of that 500,000. Okay. So make sure you're being pre-approved or approved for the right sales contract amount. Okay. Not the loan amount. We're talking sales contract, because you need to make sure if you're looking at $500,000 that you can get approved for $500,000, because it's going to be a 3.5% down payment if you go FHA, or it might be a 3% down payment going conventional with some of those programs, Home Ready or Home Possible, or it may be up to 5%. It may be any, increment of that sales price for the down payment, but you have to know the loan program that you're working with, and you have to know, get approved for what you can afford and what you feel comfortable in paying for that down payment. So let's talk about that. If you are interested, let's just go conventional. Let's talk conventional right now, okay? You're interested in a conventional purchase you're interested in doing conventional lending, a conventional loan program for a purchase of a property that's $500,000, okay? And you're not going to use Home Ready or Home Possible. Those are two loan programs that are very valid in the 2021 year. Right now, they're valid, Home Possible and Home Ready. These will allow you to put 3% down on a conventional or a conforming loan. Now, let's talk about that. If that is what you choose to do, great. Now, there are some cases, and this is a bit taboo when I'm going to talk about next. It's a bit taboo to want to get to a certain payment and buy your interest rate down. What do you mean, Shirley? If you want to buy down your interest rate, that basically means you're willing to pay points. Points. That means you're willing to pay points. That means that's going to add to your closing cost. There's often times where clients will say, well, I want a certain payment. I want a certain payment for this loan size. I want to buy a $500,000 house and I want my payment to be $3,000. Okay. And these are all just examples. Don't take me word for word on these dollar amounts. These are just examples. I'm throwing them out there to kind of give you an idea about down payment monies and closing cost monies. Okay. You do the Home Ready or Home Possible program, right? On a $500,000. So that's 3% down. Matter of fact, let's just change and get rid of the Home Possible and the Home Ready, because these are two valid programs. Yes, they talk about 3%, but they also are a little bit more involved if you're going to do the 3% down. Okay. So let's talk about a regular conventional that you really only want to put 5% down. And this is for the single family residence, okay? Not a multiple unit, not a 2-unit, 3-unit. We're talking about a basic single family resident that's a $500,000 and you want to put 5% down, okay? But you also want to put 5% down, okay? And have your payment $3,000, okay? Let's talk about that. 5% down of $500,000 is $25,000, yes? You want your payment at $3,000. Now, today's rates are really, really good, okay? You might be at about 3.125, 3 1/8 with no points, okay? No points, no buy down. It doesn't cost you anything to be at a 3 1/8, 3.125, right? But at a 3.125 on a $500,000 loan is not going to get you a $3,000 payment. Not when you have to have your property taxes and insurance and PMI included in this payment. Why do I have to have PMI, Shirley? Because you didn't put 20% down. Ah, right. Okay. So if you aren't putting down 20%, and that's totally fine. You don't have to put 20% down on a single family resident going conventional. You can put 5% down. Yes, you can. But you also have to remember you're going to have PMI. You're going to have property taxes that you have to impound into that payment. And you also have to have homeowners insurance or hazard insurance, fire insurance, what some states call it. But it's all that insurance that protects that property, or it indemnifies the property if something casualty would happen, right? So property taxes, homeowners insurance or hazard insurance or fire insurance, and PMI. These three components are part of that principal and interest payment when you're considering 5% down on a single family on a conventional loan. Okay, so I want my payment to be $3,000, surely on $500,000, and I'm only going to put 5% down. I'm probably going to tell you, nah, that won't be the case, because at 3 1/8 on $500,000, that payment is not $3,000. Okay, it's going to be higher. Now, some people, okay, will automatically insist, well, I'll just put down 10%. Totally no problem. 10% of $500,000, $50,000. Okay, still we're talking about the down payment. Okay, so at $50,000 down, or 10% down of the $500,000, if your interest rate is at 3.125, you may get closer to that $3,000 payment. Okay, you'll be a lot closer than if you were to put 5% down. But how's about this? Here comes that taboo. Here comes that taboo conversation I'm going to present to you. Another option. Instead of putting down $50,000 or 10% down, mind you, with that 10% down, you're still going to have PMI, private mortgage insurance. You're still going to have that, because 10% down is not 20% down. So you'll still have that PMI. But how's about this? Taboo. How's about pay some points? Buy your interest rate down. Pay some points. Buy some interest rate. Buy your interest rate down. Pay some points. Buy your interest rate down. Now, see, I know, oh my gosh, no, taboo. We don't pay points. We don't pay points. But why not? You want your interest rate to be at a certain rate so that you can get this certain payment. You said, surely, I want my payment to be $3,000. In order to get to that $3,000, why not consider buying your interest rate down and pay some points? Here's why. If you buy that interest rate down from 3.125, let's say, down to 2.75, that from 3 1/8 to 2.75, that might be $12,000, $13,000 versus another $25,000 because you want to go 10% down. So you'll have $25,000 for the 5% down and another $25,000 to get to that 10% down, or call it 50 grand. Who wants to pay $50,000 when you can pay an additional $12,000 or $13,000 on top of this $25,000 and call it $37,000 or $38,000 versus $50,000? What you're doing is you're assuring yourself that if I buy this rate down, one, it's going to be cheaper. Two, you're going to be a lot closer, if not right at that $3,000 payment. Make sense? So that's all I'm trying to understand or trying to present to you all as an option. Sometimes, and it may not be always the case, because I can't give you every rate scenario and every cost that is associated with buying down that rate. I'm just throwing these numbers out. Like I said, these are estimates. These are just some examples to kind of show you what it may look like. What I'm trying to explain to you is perhaps you should ask your broker or your loan officer who's working on your loan, ask them, hey, is it more advantageous or cheaper for me to buy this rate down instead of doing 10% down or 15% down? Because at the end of the day, if you're not doing 20% down to get rid of the PMI, then you might want to look into just simply buying down the rate. Because buying down the rate or paying points is a whole heck of a lot cheaper in some cases, most cases, than putting more money onto your loan for a down payment. Now, it is taboo. It is taboo in some cases, in some people's minds and trains of thoughts. It is taboo because who wants to pay points? That's just throwing money away. Points are tax deductible. Yes, if you were to put more down payment on your loan, that is bringing down your balance, your principal balance. It is bringing it down, yes. However, if you're not quite ready to put an extra 5 or 10% down, consider buying down the rate. Because if you have to have a certain payment, Figure out what that configuration of that particular rate for that day would cost you versus, like I said, another 5% or another 10% down. You might come out cheaper. It's just another option, as taboo as it may seem. It's just another option to get to that certain payment that you're looking for. I'll buy my rate down. And whatever that buy down is, maybe it's 12 or 13%, whatever the buy down is. Like I said, I won't give you, a specific number and that's guaranteed because these are just estimates. But just let's think, if you were at a 3.125 and you wanted to drop it down to a 2.75, consider it maybe 13, 12. I don't know how much it's going to be based on your particular profile. But whatever that number is, that cost to bring that rate down may be a little bit cheaper than adding more on your down payment. And that's what I'm saying. And like I said, a lot of people over the years are really strict on, I don't want to pay points. I don't want to pay points, Shirley. I got it. I get it. But in some cases, let's, start to channel our train of thought. And I bring that up to you because, again, these are real life examples and scenarios that have happened in maybe the last 30 days with some of the clients. But I have some clients that don't mind paying the points because, again, it is advantageous. In some cases, it is a tax write-off. The points are, down payment is not. Your down payment, you're not getting a tax write-off for that. But the points, they're tax deductible. Yeah. So I say, weigh your options, folks. Just weigh your options. Now that's a little bit about the down payment, okay? Let's talk closing costs. Yes. So after this down payment, and this is why sometimes it may be a little advantageous, a little cheaper, a little wiser to buy the rate down for the sake of money, because that's just the down payment side of it. Now let's talk about the closing costs. Yeah, so you're going to need to do an appraisal, okay? You're going to need title and escrow to get involved. You're going to need the underwriter to get involved. You're going to need to record the deed. You're going to need to pull the credit report. All of these items I'm naming are legitimate closing costs that are on your loan. Now, every now and again, you may find a lender that says, oh, we'll credit you all this money for the closing costs, or you might even get a seller, I don't know where, but you might even get a seller that says, hey, I'll pay half of the closing costs. But just keep in mind, closing costs are in addition to this down payment. You need both in most cases. Okay, so don't get complacent in thinking, oh, well, I only have just enough for the down payment. Well, let's start getting some resources going for your closing costs. Resources, maybe the seller will pay them. I don't know. Maybe you'll get a gift. Yes, you can do a gift from a family member and close friends sometime. Well, but just know you can get a gift from someone who is what they call the donor, can donate you funds to help you close your loan. Okay. Or you can dig into that retirement plan, that 401k. You'll be surprised at how many clients that continuously say, yeah, Shirley, so I have this 401k, or yeah, I have this 403b, or I have this savings retirement plan through my company, but they won't let me borrow any money from it. You'd be surprised. Yeah. You'd be surprised at how many of these retirement firms and companies and brokerages that hold your money that will say to you, oh, we may not loan you money for a car or a vehicle, but we'll certainly help you with the down payment. Sometimes they just call that a financial hardship. Don't ask me why the term is there. I have no clue. But sometimes they label that as a financial hardship when you want to purchase a home. And they'll ask you for your settlement statement or a loan estimate. Okay. They'll ask you for some sort of estimate to see exactly what you're doing. You got pre-approved for the house. Here's what you're pre-approved for. And here's how much money I'll need. You send all that to your retirement brokerage firm, who's ever holding that money, and you'll be surprised at the outcome when they say, oh yeah, sure, you can borrow against this, or you can withdraw this. Yeah. So start thinking about your resources early. Or you could also get a co-borrower. Yeah, you can. And what do I mean by that? Well, let's just say you've got young little brother, right, who's wanting to start building his real estate portfolio, but maybe he doesn't quite have enough income, right, to buy his first property. So he wants to buy a single family resident, and he gets pre-approved for just a little bit of money, right? Let's just call it $200,000. Here in LA, that's just a little pinch, right? So $200,000 he gets approved for, but he wants to buy a $500,000 house. He wants to buy his first house. He wants to buy it $500,000. You can actually get, little brother, you can actually get big sister to go on the loan with you. Yeah. And guess what? She doesn't even have to live there. She doesn't even have to move in. She doesn't have to say any of that. You can have primary borrower that's going to stay in the property, little brother, and then you can have older sister be the non-occupying borrower. They're called non-occupying borrowers. And that is totally allowed if you're going conventional, right? If you're going to buy a conventional single family residence, you can put older sister on the loan with younger brother. And you can even do that for multi-unit. It's just that you'll have to put more of a down payment, okay? So you can do more of a down payment, right? And have the co-borrower as a a non-occupying owner, co-owner. You can have that with a multi-unit, single family. But all of these items or all of these options, you'll actually have to talk with your lender, your broker, and find out what the down payment is, okay? Because on a multi-unit, if you're going to use a non-occupying co-borrower, you can't have just 5% down, okay? It depends on the units and the credit scores, some other things that kind of go into play, but it'll be more than 5% down payment, okay? So just keep that in mind. But the single family, you can always do that one, unconventional. And that person doesn't have to live there. So those are some options and some resources that I'm hoping that you all are understanding, and hopefully this kind of helped out a little bit in cases of when you're trying to buy a house. I hope this is helping you out just a tad bit, because all too often I think people forget there is a down payment and there are closing costs. Two separate things that have to meet in order for that loan to close, okay? But there's options, and there's different scenarios that you can do. So start talking, because if you don't ask the questions, we don't know what you want, okay? So let's just make sure you're doing that. But I wanted to bring that to your attention, down payment and closing costs. Also, if we want to, let's talk a little bit briefly about the credit report. I know we've talked about this in the past. A lot of my podcasts are geared or towards credit and looking at credit scores. I'm kind of mentioning that throughout the times I'm talking to you about on these podcasts, but the credit is so very important, right? The credit score, so very important, right? It's the middle score that we look at. We don't look at the high score. We don't look at the low score. I mean, we see it, but the middle score is what we're qualifying you on, okay? That middle score. And if there's two people on the credit report, we're going to use the lower of those two middle scores, okay? So husband and wife, husband has a 700 middle score, and the wife has a 750 middle score. We're not using the 750. We're using the 700, okay? So just keep in mind, it's the lower of the two middle scores, okay? If you have credit things that are going on the credit report, make sure you are looking at them and understanding before you try to get pre-approved. What you see, I'm going to see too. But what's going to be worse is my score that I pull is going to be lower than your score. I don't know. Like I said, I've tried to explain this to the best of my ability. But whenever you, the individual, pull your credit score on credit.com, freecreditreport.com, Credit Karma, all of these other little credit reporting agencies, they're like a mom and pop shop, right? These Credit Karmas and stuff, they're not affiliated or governed by Experian, Equifax, and TransUnion. They're not. They're like mom and pop shops that have figured out a way to give you your credit score and their credit reporting, okay? Although these scores are attributed to Experian, Equifax, and TransUnion, yes, but they're not their scores. They're hard scores that us lenders pull. So when you, the individual, pull them yourself, most of the time, hate to be the bearer of bad news, most of the time, if not 99.999% of the time, your score that you pull is going to be higher than the score that I pull, the lender, okay? And again, different credit repositories, right? Different repositories, credit reporting agencies. There's all kinds of formulas and configures that go into these reports, right? And whatever we pull as a lender is what we use. And I know a lot of clients, well, Shirley, I just pulled Credit Karma last night and my score was an 820. I know, but I pulled a 780. And guess what score we're going to use? My 780. Yeah. Okay, so don't get concerned and bent out of shape. The reason why you want to keep pulling your own scores, very important, especially during times of casualties in the world like pandemics and COVID. You want to keep pulling your scores every 6 months, or not your scores necessarily, but your credit report, okay? Your credit report is more of what you want to keep your eye on every 6 months. The score, because again, your score is not going to be the score that I use. So your credit report is more so what you want to keep getting every 6 months, right? You want to get TransUnion. You want to get the Experian report and Equifax report. Those three national credit reports are what you want to target every 6 months and keep your eye on those reports, right? You want to know what's going on in those reports. And every 6 months is a great measure of where you're going to be as far as any blemishes, any fraud, right? Fraud is going rampant in this day, in this day and age. Fraud is rampant. And you want to know who's sticking things on your credit report or using gosh forbid, using your credit to get what they want, right? So be mindful and keep your eye on your credit report. Not so much the score, but the credit report, because what you see on there, I'm going to see it too, and then some, okay? Also, about the credit, I know there's a lot of clients out there that, I'm going to do the self-reporting utilities. If you don't know what self-reporting utilities are, that means, pretty much in a nutshell, you have called TransUnion, Experian, Equifax, and you have said, hey, stick my cable bill on my credit report. Stick my power and light bill on my credit report. Stick my insurance payment on my credit report. You self-reported that utility on your credit report. Now, is it bad? Is it good? I'm kind of indifferent because in some cases, it helps boost the score. In some cases, not so much. Because what happens is when they get your cable bill, right? And your cable bill says balance due $100, they don't have anything to put in the limit column but the $100. So now it looks like your self-reporting is maxed. It looks like you've got a maxed credit line on your bureau. And we all know having a maxed credit line on your bureau really doesn't help the credit, right? So be mindful of how these self-reporting utilities will help or not help your credit scores, okay? Like I said, I'm not the credit guru. I'm not a credit repairman or credit fixer-upper or whatever you want to call it. I'm just giving you some of what I've experienced, right? Some of what I've experienced with those self-reporting utilities that you have put on your credit report. Just be mindful of the numbers that they're using. Are they using what's owed as well as it being the same as the limit? Are they calling your due date on the 1st when you don't pay it to the 15th? Are they calling that a late? I don't know. So be mindful of when you're trying to put these self-reporting utilities on your credit report. A better option, and we've done this and seen this time and time again, a better option may be just to find someone, and when I say someone, I'll just use that loosely, but hopefully you find a family member, a close friend, someone that you trust, right? That has maybe, let's call it a Citibank MasterCard, right? A Citibank MasterCard with a limit of $50,000 and maybe they only owe $10. That's the person that maybe you want to ask, hey, can I be an authorized user on your credit card, right? Because then if they allow you to be that authorized user, it doesn't affect your debt to income ratio for the lending purposes, but it sometimes will boost your score because what it does is it makes it appear as if you have credit purchasing power, right? You've got a $50,000 limit and you only owe $5, right? So that's more of a win-win as an authorized user, not a co-signer, but it's actually called an authorized user, you may want to think about getting yourself on someone's credit card like that. And then that Citibank MasterCard, that trade line, that creditor you can take with you and put in your arsenal for when it's time for you to purchase. Okay. Like I said, it doesn't really concern refinances. For those of you out there who are already existing homeowners with a mortgage or without a mortgage, when you refinance, closing costs are going to be there most of the time. Closing costs will be there, but you don't got to go borrow. You don't have to go ask. You just put it on your loan because it always comes in. Well, and it depends. Again, if you're one that says, oh, I don't mind paying the closing costs, have at it. But most refinances, especially if you're doing a cash out refinance, meaning you're getting money to pay off bills or you're getting money to add an additional room or a bedroom or increase your square footage. If you're doing all that, that's a cash out. When you're getting monies in your hand, that's a cash out. And typically, those closing costs will be rolled into the loan so that you're not paying out of pocket, right? Refinances, your closing costs are rolled into the loan, so you don't have to pay that out of your pocket, okay? So again, I'm your girl, Shirley. It's Mortgage Money with Shirley. Twice a month, I'm here live and direct at the Morris Media Studios here in Los Angeles. Like I said, I wanted to come give you a little bit of a tidbit today, a little nugget, because I am going to be here twice a month. I've been doing this now for 11 episodes. This is episode 11. So you can find these episodes, all of the episodes up to 11, right on my Mortgage Money with Shirley YouTube channel. So make sure you subscribe, take a look. And if you have any questions, comments, or concerns, like I said, I will answer them for you. My cell phone number, area code 818-720-7575. Again, my cell phone number, area code 818-720-7575. Feel free to give me a call, shout out, text, or DM if you have any questions about mortgage lending. I promise I'll try to do my best to answer them. So it's been a pleasure. And I guess that's my Thursday, September 2nd. And have a happy, blessed weekend, guys. Have a great, happy holiday. Take care.